like and subscribe. Don't forget to like and subscribe. So today I want to talk about BBBY, Bed Bath and Beyond, right? So kind of we had a crazy run, like literally from $1 to $5. So a lot of people bang. So congrats if you got in. But today I want to talk about how you can actually benefit this volatility, right? Like really high volatility. So this strategy is not call or put, right? But you can still make a lot of money using the theta strategy, selling puts, right? So I'm gonna talk, right? The issue right now is the volatility is really high, and if you see that, right, like I got some right around here, but it's slowly kind of coming down. So I think volatility is coming down. So basically this is pretty much non-directional unless like BBBY kind of goes to zero, which I think some other companies probably gonna acquire it like $1 or something, because right now market cap is 400, right, when the price is what, like 357. So it's about $100 million. Still they have a lot of stores, and lot of they can salvage a lot of things. So I think they probably like they they should be more than $1. Again, I mean, it can absolutely go to zero. You gotta do your own risk analysis, but if you are interested, I'm gonna talk about how you can basically take advantage of high volatility, right? So let's look at the BBBY. So really bottom out after the bankruptcy things, like from almost from 250 to within 2 days it went to 127. Then after that we had a crazy rally, right? So it seems like the rally is done now. We are kind of, the volume is coming down, the price is kind of coming down too, as well as the price of. So this is BBBY in Robinhood. No, now we're gonna look into the trade options. So what I was looking at for 1 year, right? So if you look at the sell put, right? So if you're looking at selling puts and expiring in basically in like 24 January, right? You have about a year. And if you look at like even dollar, right? Okay. Oh wow. Oh no, break even is 30. Okay, if you look at the dollar one, they're paying like $67. I actually got right around $75. So even the price was high, which should be really opposite, but basically it's happening because of the implied volatility. It's really 285. So I think if it comes down to, so you're gonna make money with the volatility. If it drops, basically the premium drops, right? Then you can just buy back. But right now, uh, can I just get rid of? Okay, yeah. So you can see that, right, 385. So what you can do is, so basically what you are really doing is you're selling puts for dollar. What you are saying is like, if the stock goes below $1, you are buying stock at $1, but you are getting $67 in credit. So basically think about, if it goes to zero, you're not losing $1, you're losing like almost 70, right? So 33 $33, right? So if it goes to zero, you're losing $30 per contract, right? But basically even if it goes to 30-40 cents, right, you are profitable. So up to 40 cents you are profitable. But the goal is, we are not trying to really wait out till end of the year and whatnot, right? So if it goes, basically if it goes opposite me, like if it goes to like $1, I'll just buy back, right? I got it 70, so I took like what, you know I take $30 per contract loss and just get done with it, right? If you have 10 contract, that's $300. I mean, it's not a winner, right? But I think, like, I feel like at least it's in your favor right now. Even if the price goes up or down, I mean, this volatility, it's just like there's so much premium, right? There's so much premium, like $67. And I think like it has pretty good volume. Look at that. Today we just opened an hour ago, we have already 70 contract traded today, and open interest is 24,000. So there's a lot of so basically, if the price stays same, or kind of volatility, or if it's above one, right? So if you see a quick spike, you can sell your contract and make some money, right? Or if you basically the price kind of, even it can drop to like $2-3 and still be profitable. It's the volatility drop, which if you see last 3-4 days, it's kind of dropping. So if you look at this, all you are doing is this, right? So you sell one put, expirations. Maybe you can play around with the other expirations, maybe some others. I don't know. Maybe we can check it out. If you look at May, I don't know. Maybe it's not paying that much, but May is paying 40, which is not bad actually. You don't have, we kind of drop today, but all you are doing is selling this, you getting, so you, by doing this, you getting $67 credit. But keep in mind, you need to have $100 collateral, right? So you can close these positions any, and you can actually see this nice, yeah, your max loss is basically $33. Your break even is if stocks goes to 30 cents. So as long as stocks is above 33 cents, you're profitable basically, right? And you can see that, right? Uh, your max is 33 if the stock absolutely go to zero. Even if you go like, 15-20 cents, you lose, but you won't lose much, right? But if the stock is like up, uh, yeah, up a dollar or more, you are profitable. Even if it's like, stock is 67-70 cents, you are profitable. So yeah, check it out and see what you guys think. If you guys have any question or comment, let me know. That's it for today, and have a great day. Thank you.